6 to 8 months ago, a lot of DIIs were buying a lot of pharma companies. At that point, there was no information on pharma, but they knew that something would change.
The art is in finding the trigger which will change that view. See, why do stocks go up, right? Because someone's buying and willing to buy at a slightly higher price. That's basically what it is. These were the trigger points where you knew well in advance that, the numbers are going to improve.
So is it better to track the index to see if there's an uptick in the index? That means the underlying stocks are also going up?
Yeah, you could do that. The sector index, for example, you could do that. Or you could just keep a screener on the individual. Invariably, apart from your portfolio, you should have a watch list of things that you're looking at. Not necessarily convinced at this point in time. When we asked people, what are you going to spend this money on? Why are you taking this personal loan at 16-18%? And they said it's for travel. And they said, why are you doing that? It's because their kids are putting pressure because they want to put their photos up on Instagram.
The mutual fund industry and all of them, how do they find sectors before a retail investor?
Usually there are two sources. One is
So in today's episode, we are going to dive into futuristic sectors. Now, when we talk about futuristic sectors, we usually get distracted with a lot of things that are going on in the market. Whether data center is a good sector, is it semiconductor, is it electric vehicles? But what really happens in the market is completely different. So in today's episode, we are going to really understand what are the key futuristic sectors and how to actually identify them well in advance. So Unmesh, for this episode, I want to mainly understand how do institutions and the mutual fund industry and all of them, how do they find sectors before a retail investor? And I'll give you an example, right? Because 6 to 8 months ago, I noticed that a lot of DIIs, domestic institutional investors, were buying a lot of pharma companies. At that point, there was no information on pharma, nobody knew what was happening, but they knew that something would change. And then 6 months later, pharma sector became the most happening thing. Now, how do we try to find the same thing out, and how do you find this in the first place? That is my first question.
Yeah, so look, there are two different ways in which you look for what is called the next big sector. Okay, we could talk about it all day, in fact. But usually there are two sources. One is sectors which you don't know anything about, and something big is going to happen. And then the second is, your example on pharma, which is that something's down in the dumps, and then you are going to see some kind of uptick again, and you try to catch it early because that's where the alpha kind of gets generated. I think on the first one, it really depends on what is driving that change. So to give you a couple of examples, there could be a government policy which is changing something. For example, recently when we had upgraded our EMS, the electronic manufacturing, we have coverage on things like Dixon and Keynes, where the government is driving manufacturing. So which sectors are going to benefit, and then you kind of take early positions within that. Or, there is an advantage that you have in India, which you probably don't have in a country like the United States, is the fact that India inherently is not at the cutting edge of most things. Usually we are followers of trends which are seen globally. Not always, but usually. What that means is, to give you an example, is that if you look at the journey of the consumer up the chain in something like the United States and then most recently in China, you can see trends emerging as to where that incremental wallet, when someone gets richer, where do they spend that money, and you can then extrapolate that to India. So, things like footwear or jewelry, and these are, or organized retail, for example. Now, mind you, it doesn't always go in that direction. You will always have cases which are unique to India, and we can talk about that separately, but that gives you a very good segue as to where the next big sector could come from. The other is that this whole turnaround story. Now, look, here what happens is that it's easy to identify why that a sector is cheap. It is also not very difficult to find out why it is cheap. The problem is that what is going to turn it around. And if I take the case of pharma versus chemicals, for example, right now we are actually in the middle of that. I think the art is in finding the trigger which will change that view.
Yeah.
See, why do stocks go up, right? Because someone's buying and willing to buy at a slightly higher price. That's basically what it is. So what happens is that maybe 18 months ago, when the investors started to see, or institutions started to see that the price pressures in the United States market had started to come off for pharma, for example, and some of the some of the investments that were done by the pharma companies in their specialized products started to show up in sales. These were the trigger points where you knew well in advance that the numbers are going to improve. Now, when the numbers actually get delivered is not when you buy, because that's when everyone knows it. What you have to do is that you have to be sufficiently early into that and maybe even take a little bit of pain to wait for that to play out. Now, chemical right now is in a situation where it's in the dumps because of the fact that input prices are creating a problem. But is there a trigger to turn it around? The market's not seen it, which is why, till we see some evidence that this is going to happen, I don't think the investors are going to start buying.
That is interesting, because when you spoke about chemical, right? I know a lot of fund managers talk about this, where they have this thing called neglected sectors, right? They like investing in neglected sectors. Now, for a retail investor, I don't know when the trigger will happen. So I can invest in a neglected sector in the peak of a bull run and get zero returns for the next 12 months. So that becomes a problem. Or when I try investing in the sector like pharma, I'm little late for that party as well. Now, as a retail investor, if I have to look at a sector, even if it's in a neglected sector, now we talk about growth triggers, as you said. How do we find this growth trigger, right? What are some examples maybe you've seen in the past? Because all these sectors are like a cycle. Pharma was also a cycle, COVID down, chemical up and down. So in the past, have you seen anything like this playing out with respect to key growth triggers? Because I know we can put a parallel into the future as well in this.
Yeah, so look, what happens is that actually there are two issues within this, because one is that, just because something's in the dumps does not necessarily mean it will come out. Something which has terminal value of 0, for example, there is a sector which is dying for whatever reason, right? So what happens is, just because something's cheap is no reason to buy it. What you have to be cognizant of is that you have to be able to early spot that this thing is improving. And this is a classic value trap. Okay. For example, at some stage, coal will go through this cycle, right? Oil will go through this cycle, that the entire consumption basket is actually moving away. So while there will be times when it goes up and down, in essence, that slowly things are actually falling. What you have to do is to figure out what is going to turn that. Now, I'll give you an example from when I was an analyst in real estate back in 2009. Stocks at the peak of 2008, I remember in January, started to fall. Now, when stocks fell 50-60%, everyone thought that maybe now is the time to actually buy this. And I remember that there was a short rally in September, October of 2009. And that it was like stocks had doubled actually. Even though it was a small rally for a few weeks, it actually doubled. But then people realized that even at that valuation, the numbers are not going to show up. So something can fall 60% but still be expensive, basically. So when something gets so overvalued at the start of the, at the top of the peak of the bubble, it can actually burst a lot further. And then stocks took another downturn which went deep into January 2009, when at one point in time the stocks were 90-95% below. At that point in time, the big ones used to be DLF and Unitech. All of these were 90-95% below. Now, is that reason to buy? Answer is still no. It could still fall another 20%. Who is to say? Because if something is down 95% versus 96%, it doesn't feel like much, but it's actually down another 20%. So what happens is that you can keep looking at a false dawn. I remember at that point in time, actually, we had come out with, I was the author, we had come out with an upgrade note at that moment in time because it had come out of something very funny. What happened was that real estate analysts were completely ignored. Nobody wanted to talk to us. So what would happen is I would call up my friends who were clients and say, do you want to catch up for lunch? And they would say, okay, yaar, real estate, kaun dekhega? Luckily, I was to do consumers, so I used to get a few meetings, but actually there was nothing much going on. And what happened was that our banks analyst had a meeting with one of the larger private sector banks, which in history had been, had been funding real estate projects. And he was going to meet the credit manager. So I said, look, I have nothing to do in the office. Let me come with you. I was just sitting as a mute spectator doing nothing. And that credit manager there said that we are now thinking of evaluating projects on merit on underlying asset base and start lending to the project again. This was actually the crux of where we understood that funding will come back into the sector.
That was the trigger.
That was the trigger. Now that is too far in advance, right? So I remember coming back, analyzing that, talking to 20 people, finding no real evidence other than this and putting out a note, and it took us a couple of months to figure out that, yeah, maybe. And in March, that report came out, and actually these stocks from there actually quadrupled in the next four months. So what happens is that you could come across the job of the analyst is to ensure that you are picking up the triggers and keeping your ears open from where actually the crux is. So there are ways to do this. As long as you keep your ears open, I think you can find the turnaround.
No, so I have a question. That means analysts usually find these triggers
Yeah.
maybe slightly well in advance or maybe a little bit in advance, right? Do they usually release the report sooner or is it too late by the time? Because I know in the pharma time when we saw in the last 6 months, before the reports were out, FDI investing had started. So
Yeah.
is it easier to track that or track the analyst reports? What do you think is better?
Yeah, so look, there are two ways to do this, right? One is to actually see where the holdings are moving. Because look, what happens is that there is, so the analysts who are on the road will find it first. Okay, but also the buy side also has analysts of their own, so they are on the road trying to find these things as well. What happens is that there is a certain amount of rigor that you have to do before you put out a research report. It's not like I can come up with some thesis in the morning and then just start writing a report on that. The research, you have to do a little bit of rigor. You have to check with a few places as to whether this comes out or not. So there will be some lag, maybe a week or two, but yeah, not that much. So you can still follow the research reports and do that. Otherwise, obviously, the mutual funds are already starting to move. You can see from the patterns of stocks. What you should do is that if you have a neglected sector, and you believe that at some point in time it turns, and you are not the one because you are alone versus someone running a 20-member team. You have to put it on your screen, in whatever app you're using, and keep an eye as to how it is moving. Usually turnarounds are visible just on the trading pattern. That's when you start looking. See, someone's buying, which is why the stock's going up.
So is it better to track the index to see if there's an uptick in the index? That means the underlying stocks are also going up.
Yeah, you could do that. The sector index, for example, you could do that, or you could just keep a screener on the individual. Invariably, apart from your portfolio, you should have a watch list of things that you're looking at, and not necessarily convinced at this point in time. Okay. And you can see some movement, then try and track the news. Try and see if you can find some block deals.
Now coming to futuristic sectors, right? Now in the market today, there are almost every sector looks like a futuristic sector. The way it's moving right now, everything seems to be $1 billion or multi-billion-dollar opportunity. But if you had to narrow down or pinpoint, like if I had to pinpoint a few sectors, even from an HDFC standpoint, right? What have you seen in the past that might do really well in the next few years, right? I'm not talking about short term. I'm talking about proper long term itself.
Yeah, so look, I think there are some very large themes which are playing out. Okay, if I look at the very long term, the one very clearly which stands out is the shift in the energy basket. Now, the thing here is that there is enough geopolitical reason as well as macro reason for the government to be pushing that. We've committed to zero carbon, for example, and it's a global phenomenon. And on top of that, because we've never been self-sufficient as far as oil is concerned, in any case, there is a good enough reason to shift out. So if you look at that, players like LNG, for example, there is a lot of liquefaction capacity coming on. So that becomes one very, energy basket is one very big.
So triggers are there as well in the energy basket.
Yeah. You can
quite
see
a good,
because globally there is, if you can see the investment into the gas, for example, as a transition fuel to eventually to EVs. Is there. So, you can see that the trend is happening, and for India, it makes sense geopolitically as well to be in that space.
And this is something you mentioned, right? That we see usually these sectors performing well in other countries, and then there's a lag effect that comes in India.
Yeah.
I think energy was that lag effect.
Energy is definitely one of them. Then, on the consumption side, I think there is a very big story still yet to play out. Even
India consumption?
Yeah. Because see, what's happening is that we had done a rural report. The institutional team had done a rural report where out of the 650 odd districts that we have, we found that actually, while on an aggregate basis, our per capita income has not reached that inflection point where things started to take off suddenly in China. There are individual districts, 200, 300 districts, where actually this is happening. So what will happen is part of the country will suddenly become like China in terms of consumption. Now what happens is that if you look at theoretically, if you look at the basket of consumption, the first need is food, right? But as your income levels go up, as my mom used to say, you can only eat so much, right? And then you can only upgrade your food so much. So what happens is that food as a percentage of your consumption basket falls. Same thing happens with fuel. So as a percentage, it's all coming off. And the rest of that money is basically going into two big avenues. One is savings, which means financial participation, because then people want to build wealth. And the other is consumption, or what I would say conspicuous consumption. because what will happen is that FMCG also beyond a point you can't spend so much. So it's bound to go into items of fashion, jewelry, things like that. Aspirational things. Travel.
But is this sustainable?
Yeah, of course. Of course. See, there will be cycles because the economy goes up and down and there will be various points in time. But structurally, there is a very big story which can play out because incrementally, at the end of the day, literally no one is saying that per capita income is not growing at a healthy pace from here for the next 20 years. You could have a couple of years here and there. So what will happen is that as savings get accumulated and people make money, what will they do with that incremental money that they are not using for food or fuel or necessities, so as to speak, is to invest, which means that it will help asset management companies, brokers, insurance.
And we're seeing that right now.
We're already seeing that. But
that play.
The point is that it's even with the expensive stocks, it's a long way to go in terms of the penetration story.
Wow.
And then the second is as I was talking about the conspicuous consumption, what is called the inflation of aspiration, or rather people spending more to keep their lifestyle better, even though it's on the same thing. Premiumization basically of lifestyle. So traveling abroad, and then there is this whole phenomenon. I remember talking to one of these DSAs for the banks who was telling me that the single biggest contributor to growth of travel in India, single biggest, because when people take personal loans and travel, now you are not expected to disclose what you did with the personal loan, but the banks do ask. So the DSAs are where the information is sitting, and he was saying that when we asked people what are you going to spend this money on, why are you taking this personal loan at 16-18%, and they said it's for travel, and they said why are you doing that? It's because their kids are putting pressure because they want to put their photos up on Instagram. Now,
wow.
That is the crux. Now, had I ever thought that I would like to go and take a picture, and that is why I will spend lakhs of rupees? But the answer is that's actually the truth. So as these aspirations are changing, the spend is going to change, and that is actually what is showing up. So these are three very, very large trends which will play out.
Now, one more question I have as a retail investor. Let's assume I found a good sector, got in at the right time, maybe 1 month late, played the whole rally up, I made good money. Now, how do I know that a sector is, when do I find the exit trigger? Because when you think it's a good sector and when it starts playing out, the buzz is that it's the most amazing sector in the world and you should be invested, double down, triple down. But that is how it falls at the same speed as well, right? So when do I know that, okay, boss, this is my time, I need to exit, because exit triggers be important. So what do you think are those things?
See, it's a very, very tricky one. One thing I will tell you which is very counterintuitive, which is what I keep telling my analysts as well, and we have a lot of conversations around this, I think, is never sell just because of valuation.
Wow.
Just because of valuation, don't sell. If it's 100 times, don't sell. Yeah, I know. It's easy to say, but then something can be 80 times and hence overvalued, but goes to 100 times and you miss 25%. See, there is also psychologically that's, if you miss out on doing something because you did not participate, is a lot easier to deal with, because you can think I was not smart enough, but it's very difficult to actually let go of it too early, because what happens is that you feel like you've left some money on the table when you were there. Okay, it's like leaving the party too soon. Okay, now the thing is that, as they always say, is you always leave before, the punch bowl gets empty. Basically, what will happen is that never look at mean, because just like when something was cheap and hence the pendulum swung the wrong way, the pendulum will swing the right way. Okay, so there are 3 or 4 ways to deal with this. One is that if you're very bothered about your capital, you can keep selling a little bit at a time on the way up.
Okay.
So that way you're lighter. As price goes up, the risk goes up on the return, so you sell. Even that is really up to you. You could just stay invested. The second is that you make up your mind that what is more, for a retail investor, what is going to make it simpler for me to deal, what pain is it easier for me to deal with? Is it the pain of selling early, or is it the pain of selling, of missing the top peak? So if you are stage 1, then once you get to a valuation which is typically 2 standard deviation above the long-term mean, is where things start to get expensive. Is when you exit, and then if it goes the rest of the way, you just forget it, take it out of your Excel sheet and just move on. Or you take it to the peak, and then you do a trailing stop loss, which is you sell on the way down, maybe when it's down 10-15%. You say, okay, I missed 15, but I kept the rest of the upside. That way, at least I didn't miss the peak, something like that. But the other is that usually things tend to peak when everyone's talking about it.
Yeah, that's the scary part.
That's a scary one. The front page of the, that there is a very famous one of that countries which go into recession or start to do badly are actually in the previous year on the front page of The Economist. So happens to companies as well. Everyone talking about it, everything's great, and then you're a gym instructor and everyone starts talking about the stock, and then you start. I'm not saying you sell,
Yeah.
but now you are worried that everyone is on the trade. That is the point in time in which you start looking for bad news. And I think what happens is that try to break the clutter of looking for good news in your own thing. It's a natural, if you read the behavioral economics books, you will find that by Thaler especially. He talks about the fact that this confirmation bias. Don't get into confirmation bias. If you have something, then look for bad news. If you don't have something, look for good news.
That is very difficult. Yeah, I mean, for a retail investor, that's very difficult, especially in the bull run, right? Because I remember this. You remember the Tata Elxsi, the stock in 2021-22 went up from 2,000 to 10,000. Everyone all across was talking about this stock. Immediately after that, it fell from 10,000 to like almost 5,000, 50% drop at that point. Yeah. And nobody could have predicted that it would fall at this point. But confirmation bias was definitely there.
Unless you had read the HDFC Bank reports on this.
I don't
we had initiated coverage earlier.
People were like Tata Company, EV. I think everyone found the good things. Nobody highlighted the bad things.
Yeah.
Very interesting.
There was actually nothing wrong with the company. Yeah. Even at the peak, there was nothing wrong with the company. The problem was that when you are buying something at 40 times earnings, if I'm not mistaken, it peaked at 44. I don't remember the exact number, but something like that. It's like, why are you paying 40 times earnings, 44 times earnings for? It is ER&D, no doubt. But at the same point in time, are they delivering 44, 38% CAGR into eternity? The answer is no. At some point in time, the rubber hit the road.
Yeah, this is a good question that we've segued into, because today I'm seeing that everyone, even the retail investor, by the way, is sitting at 1 year forward P. Correct. Even today, right? Correct. Even if it is at 100 P, is like 70 pe. Agar मैं future डालूंगा 10% growth rate I will put, it is sitting at 70 P, so I will buy today at a justified value. Is that a good way to look at it as a retail guy?
Look, finally, relative valuations is what drives the market. If you are participating, then you have to find relatively whatever is the best value.
But my risk is more, right, as a retail.
Yeah, of course. See, in its inherent sense, as the price of anything goes up, the risk of that return not coming goes up. Inherently, right? But what you could look at is the premium over the most relevant sector. See, it's very difficult, and at this point in time, even more difficult than usual, to figure out how much of the stock has gone up because of liquidity, just being there, and how much of it is performance of the company.
So performance and then the premium of hype?
Yeah. So hype as in across the market. So there are 3 layers, right? Yeah. One is there's too much money, so the market itself is at an abnormal valuation of 2 standard deviation above, right? Yeah. Then every sector usually trades at a premium or discount to the market, which will go up. So if the market's gone from 15 times to 20 times, then you cannot expect the sector to then remain at the old valuation. The sector also has to go up eventually, so that becomes your second layer. So if a sector is trading at 20% premium to the market, then the normalized valuation becomes 24, not 20, right? It goes up. Now that company within that, how much of a premium is it on that? Which is all easy to get because the forecasts are available. So what happens is that if you look at premium versus the index, you can kind of, in a sense, take out the hype factor from the market. You cannot take the hype factor out of a stock. That's almost impossible to do. So then in that case, you have to take a call as to whether that makes sense for you or not. Oh. The other is that still does not mean you don't invest. What that means is that the big issue is not buying expensive stocks. You should know that you're doing it.
And you should know when to cut.
Then you say that, look, I am doing this, it's like having your 7th drink or something, right? You know that you are making a mistake, but then you should know that I have to stop here, right? Yeah. So I think it's a bit like that. You go in and you see what happens, but you keep a very close eye as to what's happening. And then you should be able to cut your loss the moment that you think that it's gone wrong. Should admit defeat, that look, this didn't work for me. I invested in something at 80 times earnings, thinking it'll go to 100. It's now at 70. Wow. I'm out of the table. That's fine.
No, that's something I learned very new, that what you've said, right? Which is find the premium with respect to the index for that index as well. Because I think what retail investors usually do is we look at management commentary. They are to giving 100% guidance. We factor that ki last 3 times he said which was fine. So the fourth time also he will do the same thing. Might do the same thing. Might not do the same thing as well. But in that those companies are sitting at 100p, 120p and all of that. So we don't factor that. But this is something very interesting that you spoke about. So one last question I have for you, right? Now, obviously you are in an institution, you have Bloomberg terminals, you have access to all the research possible, you have a lot of research analysts as well with you, right? But me as a retail investor, if I want to keep track of this, and obviously I'm at a disadvantage with respect to information. So if I want to keep track of this and identify which sectors are turning, where the trigger points are kicking in, and not just look at YouTube videos and all, because by then it is too late. How do I catch it very early before people on YouTube even put it out? So what would you suggest there, or how would you do it?
Yeah, so one is I think it's also a little bit of self-reflection for us that actually I think that a lot of tools that we use, including the Bloomberg terminal, and no offense to it, I think it's a fantastic tool, but at the same point in time, I think the more things you look at, the more noise gets generated. Honestly, life is not simpler in the institutional business because you're keeping an eye on everything. So, it invariably clutters your mind as well. But at the same point in time, I think the question is quite fair that how do you stay on top? How are you competing with somebody who has a 20-member team? It's tough, right? That still does not mean, so in the world of finance, especially in the United States, there are funds which are imitators. Okay, India doesn't have any of these, but at the same point in time, it doesn't stop you from doing that. See, information is available. Now, there are 3 categories of major institutional investors in the country. One is the foreign institution, then there is the insurance company, and then there is the mutual fund. I'm just saying in general, apart from the promoters and the banks and all of these. What happens is that every quarter, every company in the market has to disclose their holdings with name, individuals as well as institutions. And which means that insurance and FPI data on who's buying, selling on a 3-month lag basis you can get at any point in time. The mutual funds are mandated to actually give this sheet out every month.
The fact sheet.
The fact sheet. And they do it for every scheme. Okay. Now, one possibility is that why don't you imitate? You may be a little late, but at least you will catch a trend which is turning around, assuming the mutual fund is right. But at the same point in time, what happens is that you could look at the fact sheets, look at the stocks within your watch list. For example, chemicals is what you're talking about. Just see whether the 5 favorite chemical stocks that you're keeping an eye on, if there has been a change in the pace of buying or selling of that. So for example, even when I am buying stocks within the realms of compliance, I do check what mutual funds are doing on that fact sheet. Even I have the same information as an individual available as a retail guy. Because if I am buying something and everyone's selling, then I may be missing something. That doesn't mean I don't do it. It at least gives me a red flag to keep an eye on. And similarly, if there is a turnaround happening, so in pharma, you would have seen, so with a 1-month lag, all this data comes around the 10th of the month, which means in the last month, if someone's been buying something, then you can actually keep an eye on it. So on your watch list, you can start doing. In fact, you can do some, because all of this can be put into an Excel easily and all of that, you can easily do that analysis and check.
And the bulk data and all of that also gives some kind of indication and idea.
Yeah, right? So bulk data can go both ways, to be honest. Okay, because bulk data is prompted by the seller or the buyer, you don't know.
Oh, is it some big guy exiting, or is it someone desperately buying?
So you have to keep an eye as to where the bulk went. But at the same point in time, it gives you a sense. If there is a private equity exiting to a mutual fund and the mutual fund is respected, the scheme is good, then you can take a look at it. But the bulk data has a lot of noise in there.
Got it. So unless you see a pattern where a lot of bulk data is happening in the same sector at the same time by different funds, only then you would take it as
so bulk data also, the one big one that I have seen where I find it very useful is if that promoter selling. Then that doesn't mean you don't buy or whatever, but at least it gives you a sense as to, look, something's happening. If someone who knows more than you about the company is selling, well, there could be a very valid reason to do that. They may be building a hospital in personal capacity, want to buy a house, I don't know. And or it could be a private equity who's not really promoter in a sense. But at the same point in time, it's a good time to start looking at as to why this is happening.
Yeah, because if it was great, you would be buying, not selling.
Yeah, at this point in time, for example, in the last 3 months, I think insider selling is at an all-time peak. So issuances are at an all-time peak. So these are all signs that the market's heated. Now, does that mean it can't go further? Of course it can, but it just tells you that that this is a time that you start looking at as to whether you are absolutely sure about the companies that you own.
So I think thanks Umesh for this deep dive onto sectors. I think we spoke a lot about sectors, identifying what mutual funds do and how a retail investor like me can also understand and find out what are some emerging sectors, right? So for all the people who are watching this, thank you for staying till the end, and I hope you guys got a lot of information regarding this entire episode. And again, Umesh, thank you a lot for this as well. If you enjoyed this episode, don't forget to click on the like button and share this with your friends who would benefit from this amazing podcast series. Also, don't forget to click on the red subscribe button so that you can stay updated with more episodes coming up on the Make Money Matter podcast. You can also follow the show on Spotify, where we will update the latest episodes there as well. Now, one of the most important things about all these episodes is that we had experts from HDFC Securities giving you deep, valuable insight and knowledge. And all of this knowledge can be found in HDFC Securities reports as well, which is there in the description below. Now, these research reports are completely free and they offer you in-depth knowledge about the entire sector, which will also make you extremely financially smart. So follow us to get deep knowledge about each and every sector with experts. And don't forget to check out the research reports, because you don't need to go to 100 different places to check out reports, because we have all the amazing reports right here as well. And finally, the most important thing is that you need to make money matter. So stay tuned for more episodes and drop a comment below on what you think the next topic should be.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.